Welcome to FinTalk podcast series. Today we're diving into something that quietly influences so many aspects of our financial lives, the credit score. It's a number often talked about, maybe in hushed tones, sometimes with dread, sometimes pride. But what does it really mean for you, and why is it so incredibly important?
It really is a cornerstone of personal finance, a critical tool that, well, many people encounter daily without fully grasping its profound impact. This single number holds significant power over an individual's financial opportunities, shaping everything from, simple purchases to major life decisions. Our deep dive today will reveal its true role and impact.
Yeah, pull back the curtain a bit. Our mission today is to unpack this vital financial indicator, decode its core components, and give you clear, actionable insights into how it works for you, or sometimes, surprisingly, against you. We're here to ensure you're well equipped to navigate this essential part of the financial landscape. Turn mystery into mastery. Okay, let's start at the foundational level, maybe with a deeper lens. When we talk about credit in the context of credit scores, what are we really talking about? Because it feels like more than just a quick loan, right? It's about trust.
Exactly. You hit it right there. At its core, credit is the practice of borrowing money, whether it's for like a direct purchase, swiping a credit card, or a larger sum like a mortgage or car loan, with a fundamental promise to pay it back. But it's not just a simple exchange. It's a fundamental agreement of trust. Think of it this way. When you use credit, a lender is essentially extending their trust to you, believing you'll honor your commitment. If you don't pay on time, or worse, consistently default, well, that trust erodes, and that directly paves the path to a significantly lower credit score. This is where your whole financial reputation starts to take shape. It's not just about the money, but proving you're reliable.
And that erosion of trust, which shows up as a low score, it has immediate and tangible consequences, doesn't it? It's not just some abstract number hidden away somewhere. It really impacts your day-to-day life, your future plans.
Absolutely. A low credit score can severely hamper your purchasing power for future credit. It can limit the availability of loans you might desperately need. Imagine you're looking to buy a new car or maybe secure an apartment lease. If your score is low, you might just be denied outright or, offered terms that are far less favorable. Think higher security deposits or really high interest rates on that car loan. It can truly shut doors to major financial opportunities and purchases that, well, many consider essential for moving forward in life. It's kind of a silent gatekeeper.
Right, a gatekeeper. So if credit is this fundamental trust, what then is the credit score? Is it just a report card of past payments? Or is there something more sophisticated going on? It feels a bit more nuanced than just a simple list.
It is more nuanced. The credit score is essentially a sophisticated statistical method. Think of it like a predictive analytics tool used to assess how likely an individual is to pay back the money they owe. It's not just reflecting your past. It's an assessment of your future financial reliability. It's a quantified measure of the risk you pose to lenders. This single three-digit number becomes a quick, standardized way for financial institutions to gauge your trustworthiness. Lets them make rapid lending decisions without digging into every single transaction you've ever made.
Okay, here's where it gets really interesting for a lot of people. Who actually calculates these scores? Because it's not like the government issues them, right? And I've heard terms like FICO and Vantage Score. Are those the same thing, or are they different systems these bureaus use?
Right, good question. It's not a government body. There are several major organizations, usually called credit bureaus or credit information companies, that evaluate individual financial reports and then generate these scores. Globally, the three biggest you'll hear about are Equifax, Experian, and TransUnion. Those are the giants. In India, for example, you have CIBIL, which is affiliated with TransUnion, playing a similar role. It was actually the country's first credit information company set up back in 2000. So these bureaus collect tons of data on your borrowing, your repayments, everything from credit card balances to loan payment history. Then they apply their own proprietary algorithms, basically complex math formulas, their secret sauce, to crunch those numbers into that three-digit score. And yes, FICO and Vantage Score. Those are the two most common scoring models that these bureaus use to generate the numbers. Each has its own specific formula, though they often rely on very similar underlying data.
That raises a really important point then. Is it possible for for you to have different scores from different bureaus, even with the same financial info, especially with different models like FICO and Vantage Score? Because that sounds like it could get confusing.
Yes, absolutely possible. And actually, it's quite common because each organization has its own unique evaluation system. And the calculation might involve slightly different versions of those scoring models, or even just different data reporting dates from your creditors. Well, your score might differ slightly from one bureau to another, even though it's based on the same core information, like your loan payments and balances. How each bureau weighs factors, or like I said, slightly different reporting timing, can lead to small variances.
Okay.
That's why if you're planning a major financial move, like getting a mortgage, it's often a good idea to check your scores from all three major bureaus. A denial from one lender might just be because their preferred bureau happens to have a slightly lower score for you at that moment.
So there isn't just one single score for you.
Exactly. Not one definitive number at any given moment.
Okay. So beyond just the obvious thing of getting a loan, what's the actual role of this score in the real world for you? Because I think many people just stop at loans, but it seems like it reaches much further, touching surprising parts of life.
You've hit on a crucial point there. Whenever you apply for any form of credit card, personal loan, mortgage, your credit score is usually the very first thing the lender checks. It's critical. It acts as a marker for them to assess your reliability in repaying debt on time. Its main job is risk assessment. They use it to quickly figure out how much of a risk you are. If you have a strong history of paying back what you owe, you're seen as low risk, probably get the green light quickly. If your history's spotty, you're higher risk, and that initial assessment often dictates if your application even moves forward or what terms you'll get offered. But yeah, the implications definitely stretch beyond just lending.
Right. And what happens if your score isn't ideal, if it's on the lower side? Is it just a total no-go for any financial product, or are there sort of different levels of consequences?
Not necessarily a total no-go, no. But if your score is on the lower side, the credit you do manage to get will almost certainly come with a higher interest rate compared to someone with a better score. This means a higher monthly payment for you, potentially over many years. So while you might still get approved for some credit, the cost of that credit will be significantly higher. For example, on a big loan like a mortgage, even just half a percentage point difference in the interest rate, that can add up to tens of thousands of dollars in extra payments over, say, a 30-year loan term.
Wow.
So yeah, you're not totally out of the game, but a low score makes borrowing much, much more expensive. It's basically putting a premium on that perceived risk.
So a good score directly saves you real money. That's a powerful incentive right there. But what else? What other surprising areas does this number touch? Things that might not be immediately obvious.
This is where the true breadth of its influence really shows up. If we connect this to the bigger picture, the importance of your score isn't just about loans. It can also help you get more attractive insurance options.
Insurance.
Yeah. Insurers often use credit scores, or rather, credit-based insurance scores, as a predictor of responsibility. The thinking is that individuals who manage finances well are maybe less likely to file claims. So a higher score might lead to significantly lower premiums for your car, home, or even renter's insurance.
Uh-huh.
And here's one that surprises many. It can even present a more responsible image of you to prospective landlords when you're applying for an apartment, or in some industries and roles, to potential employers during background checks. While it's not directly about borrowing in those cases, it speaks to your overall reliability and management skills. That can be an unexpected edge in certain hiring or housing situations. Imagine getting that dream apartment because your score gave you an advantage.
That's fascinating.
Yeah.
So a good credit score isn't just about borrowing money. It's about projecting this reliable financial image, financial trustworthiness that extends way beyond just loans. So for those of us aiming high, what kind of concrete advantages can you expect with a really strong score? What tangible doors can it open?
Having a strong score means you're assessed at significantly lower risk. That makes it far easier to get approval for those big financial goals. Think about that dream business venture that needs startup capital, or maybe a large personal loan for a destination wedding, or even student loans for higher education. With a strong score, these opportunities become much more accessible. Often fewer hurdles, less paperwork, and crucially, as we touched on, you'll qualify for the absolute lowest interest rates available on your debt. That saves you a substantial amount of money over time, money you can then invest, save, or use elsewhere. It isn't just about getting approved, it's about getting the best possible terms,
Right.
which translates into real financial savings and just greater flexibility and opportunity for you throughout your life. It's kind of like having a VIP pass in the financial world.
A VIP pass. I like that. Okay. Understanding why it matters so much is clearly key. It's obvious a good score is an incredibly powerful financial asset. But what actually makes up your credit score? What specific things are these bureaus looking at when they calculate the number? If you want to improve your score, you need to know what levers to pull, don't you? What are the pillars holding this thing up?
Exactly. To effectively improve or maintain a good credit score, you absolutely need to understand its components. It's not a total black box. These are pretty clearly defined areas of your financial behavior that get evaluated and weighted. So the main factors, typically in order how much they influence things, are first, your credit payment history. This is maybe the most critical, making up about 35% of your score. Basically, how consistently do you pay your bills on time?
That makes sense. The biggest chunk.
Yeah. Second, your current level of debt, often called credit utilization, that's about 30%. This looks at how much of your available credit limit you're actually using, especially on credit cards. Lower utilization is generally better. Third, the duration of your credit history, that's about 15%. Basically, how long have you been managing credit? Older, well-managed accounts generally help your score more. Fourth, the mix of different types of credit you have, around 10%. This shows if you can handle various credit products responsibly, like, say, a fixed payment car loan, which is an installment loan, versus a flexible credit card, which is revolving credit. And finally, the frequency with which you apply for new credit, also about 10%. Too many applications in a short time can be a red flag. It might signal to lenders that you're desperate for credit or maybe taking on too much.
Okay.
Each of these pieces contributes to the overall picture, the Bureau's paint of your financial reliability.
That breaks it down beautifully. So, putting it all together, what does this mean for you if you want to influence your score, build that strong financial foundation? It sounds like it's a combination of being responsible and maybe strategic with your choices, almost like tending a garden, you said earlier.
It absolutely is like nurturing a garden. It
Hmm.
requires consistent care, disciplined financial habits. It's definitely a marathon, not a sprint. Every good financial decision you make consistently over time helps strengthen that score.
Mhm.
You're essentially building a narrative, a story of reliability.
Give us some concrete, actionable steps for our listener right now. What are the practical things they can start doing today, or maybe keep doing, to cultivate a stronger credit score?
Okay, absolutely. First, and this is paramount, always make your loan and debt repayments on time, ideally before the due date. Payment history is the biggest factor, so punctuality is really key. Even just one late payment can disproportionately hurt your score for months, especially if your credit history is still young.
Got it. Number one, pay on time.
Number two, keep your credit utilization low. Aim to use less than 30% of your available credit limit on your credit cards. High balances can signal risk even if you pay the minimum on time. Pay it down if you can. Third, never ignore overdue bills. Open communication with your creditors can often help. You might be able to arrange a repayment plan if you're facing financial difficulty.
Mhm.
Ignoring them just makes it worse and really damages your score.
Good point. Talk to them.
Fourth, maybe think strategically about the type of credit you're using. Having a healthy mix, showing you can manage different products responsibly, that could be beneficial over the long run. And finally, limit the number of new credit applications you make. Each hard inquiry from a lender checking your credit can temporarily ding your score a few points. Multiple inquiries close together look risky, and maybe overarching all of this, exercise self-caution, don't overspend. Responsible spending is really the bedrock of good credit, making sure you don't take on more debt than you can comfortably handle.
It sounds like building a good score is really about demonstrating consistent financial responsibility over time, proving you can manage borrowed money wisely, consistently. It all comes back to building and maintaining that trust with financial institutions.
It really is. Credit is, well, it can be fragile, but it's also incredibly powerful. Your financial report, your credit report, gains significant value when positive data is collected over a sustained period. A longer positive credit history generally leads to more accurate and hopefully more favorable results. So consistently making payments on time over years, not just a few months, that's what truly builds a robust score. It's not just about avoiding mistakes, but actively demonstrating good practice, good discipline to enjoy all the advantages of having a strong credit score. Think of it as investing in your future financial self.
Well said. The importance of a solid credit score in today's financial world truly cannot be overstated. It's not just a number, it's a reflection of your financial reliability. It's a key to unlocking better opportunities, securing lower costs on everything from loans to insurance, and ultimately building a more secure financial future for yourself.
We certainly hope this deep dive has given you a clear, actionable understanding of what a credit score is, why it matters so much across different parts of your life, and some concrete steps you can take to manage and improve it effectively. Maybe consider what immediate steps you will take, starting today, to improve your existing score or maintain a good one. Remember, your financial health is an ongoing journey, and your credit score is a vital compass guiding you.
Thank you for listening to this FinTalk episode. We hope you feel more informed and empowered about your financial journey.